Problem 10.1, Parker and Stone bought land for a new warehouse distribution center 6 years ago for $5 million. This is a sunk cost, so we're going to ignore it. They will rent these facilities from a competitor they never built on it. If the land were sold, it would net them $5.3 million. Company wants to build a new manufacturing plant on this land for $12.5 million, plus $770,000 of grading required. This is to smooth out the land and the ground and so on. What's the proper cash flow to use as an initial investment in this project? What's the total cost? Equation, plant cost plus grading plus opportunity cost. I'm going to ignore that sunk cost. So the total cost will be the $12,500,000 for the manufacturing plant, the grading cost of $770,000, and the opportunity cost of $5.3 million. Add those all up, I get a total project cost of $18,570,000. There's your answer to problem 10.1. In problem 10.2, we have Winnebago selling 30,000 motorhomes per year, $68,000 per motorhome. 12,000 luxury motor coaches at $105,000 each. They want to sell 25,000 new portable campers at $14,000 each. This will boost their motorhome sales by 2,400 units a year and decrease luxury coaches by 1,100 units a year. What's the proper annual sales figure to use when evaluating this project? Again, I want to look at just an incremental series of cash flows on a standalone basis. I only want to do the deltas. I don't want to include the new project with the old project. So I take the Delta motorhomes, the Delta motor coaches, and the new portable campers on a standalone basis. So what do? I take 2,400 motor coaches at $68,000 per motor coach, or $163,200,000. I take away from that 1,100 luxury coaches, because the luxury coaches will go down and they cost $105,000 each. So I'm going to subtract $115,500,000. And then I'm going to add an extra 25,000 portables, which is the new deal. They want to sell 25,000 new portable campers at $14,000 each, or $350 million. So these are the incremental cash flows I want to add to evaluate these projects: $163.2 million, negative $115.5 million, and plus $350 million. And I get a total incremental sales figure of $397,700,000. There's your answer to problem 10.2. In problem 10.4, we have sales of $682,900, cost of $437,800, depreciation expense of $110,400, and a tax rate of 34%. What's the net income, or the NPAT? What's the OCF, and how do we calculate the depreciation tax shield, DTS? For our equations, we're going to use the income statement equation again. Sales minus cost equals net income. For OCF, we're going to use the traditional approach. OCF equals EBIT plus D minus T. And for depreciation tax shield, depreciation dollars times tax rate will get your depreciation tax yield. So again, I lay in the numbers. $682,900 are my sales, costs are $437,800, and depreciation expenses $110,400, leaving me with EBIT of $134,700. Multiply this by a tax rate of 34%, and I get $45,798, leaving me with net income $88,902. Now I calculate my OCF by taking my EBIT of $134,700. My depreciation expense I'm going to add back because I subtracted it out. And when I'm looking for the operating cash flow, I want to add it back in because it's a non-cash expense. $110,400 extra in depreciation, and I take away my taxes of $45,798, leaving me with an OCF of $199,302. To calculate depreciation tax shield, I take my depreciation expense, $110,400 times tax rate of 34%, I get $37,536, and there are your answers to problem 10.4. In problem number 5, we have a new project with sales of $125,000, cost of $59,000, depreciation of $12,800, and a tax rate of 35%. Calculate OCF 4 different ways. Well, the way we calculate OCF, the traditional way, is EBIT plus D minus T. Bottom up is NPAT plus D. Top down is sales minus cost minus taxes. And tax shield approach is sales minus cost times 1 minus tax rate plus depreciation times tax rate. Again, I can use these last 3 methods if there's no interest expense in the income statement, if and only if there's no interest expense. So I check to see, and there is no interest expense, so I can use all four methods. If there is interest expense, I must go back to the traditional approach, EBIT plus D minus T. So first of all, this says we need an income statement. So whenever I see the letters OCF, I must build myself a vertical income statement. Sales, 125,000, cost of 59,000, depreciation expense of 12,800, leaves us with EBIT of 53,200. I take taxes out of that at 35%, and I get tax of 18,620 and an NPAT or net income of 34,580. Now I can begin my OCF calculations. Traditional approach, which always works, whether there's interest expense or not, EBIT plus D minus T. I take EBIT of 53,200, depreciation of 12,800, and taxes of 18,620, and I get 47,380. EBIT plus D, add it back because we subtracted it. And now we're calculating cash flow. Again, depreciation expense is a non-cash expense, so I want to add it back. And I take away taxes which are paid in cash. 47,380 is my traditional OCF, method number one. Method number two, bottom up, NPAT plus D. So very simple, 34,580 plus depreciation added back of 12,800, I get 47,380. I should get the same answer in all four cases. In this case, I do. Method number three, top down, sales minus cost, 125,000 minus 59,000 minus taxes of 18,620 leaves me with OCF of 47,380. Same answer once again. And finally, the tax shield approach, sales minus cost. I just took these two numbers, 125,000 minus 59,000 to get 66,000, times 1 minus tax rate of 35%. So I'm multiplying that number times 0.65 to get 42,900. 66,000 times 0.65 is 42,900 plus D times T. I take my depreciation expense of 12,800 times the tax rate of 35%, and I get 44,80. This is my depreciation tax shield. I add those two numbers together and I get 47,380. There are your answers, 4 different methods of calculating OCF in problem 10.5. In problem number 6, we have equipment that costs $975,000 brand new, 7-year MACRS depreciation method, modified accelerated cost recovery system. Calculate the depreciation dollars and the ending net book values. So I basically simply take the equipment cost times the MACRS percentages provided in the textbook and by the IRS to get the annual depreciation dollars. And to get my ending book values, I take my beginning book values minus the annual depreciation amounts. So first of all, create a table, 7-year MACRS has 8 years of depreciation. We get a bonus in the 2nd year, and we get a little bit of bonus in the 8th year. So I list the depreciation percentages first, and then I multiply these times the original equipment cost of $975,000. So 0.1429 times 975 is 139,327.50. 0.2449 times 975 is 237,777.50, and so on, all the way down the table. I just multiply these percentages times 975,000. When I'm done, all these depreciation dollars should add up to $975,000 if I've done my homework right. So the depreciation percentages should add up to 100%, and the dollars should add up to the original cost of the equipment, which is $975,000. Then to get the ending net book value, I just zigzag on down. So to get this first ending net book value, I take the $975,000 new minus the first year depreciation of $139,327.50 to get my ending book value of $835,672.50. Then for the 2nd year, I take $835,672.50 minus $238,777.50 to get $596,895. $596,895 minus $170,527.50 is $426,367.50, and so on. I just zigzag down to get my final ending net book value numbers. And at the bottom, if I've done my work right, I should get ending net book value of 0. So there's three ways to check these things. Number one, make sure your depreciation expenses add up to 100%. Percentages, add up to 100%. Make sure your depreciation dollars add up to the original cost of the equipment, and make sure your ending net book value zigzags down to 0. And these are 3 ways you can check your work to make sure you've done your MACRS problem correctly. There are your answers to problem number 6. In problem number 7, we have an asset that costs $640,000, going to be straight line depreciated over 8 years to 0, so all the way down to 0, straight line depreciation this time. We're going to use this asset in a 5-year project. Asset will be sold at the end of 5 years for $175,000. If the tax rate is 35%, what is the after-tax cash flow? So if we sell this asset in year 5 for more than what's on our books, we have a gain. And if we sell for less than what we have on our books, we take a loss on it. Annual depreciation is the asset cost over 8, so the straight line is very easy. So I have a depreciation expense of 0.1250, or 100% divided by 8, 0.1250, 12.5% a year, all the way down for all 8 years. Depreciation expense is 12.5% of 640, or $80,000 per year. And I get my ending book values by zigzagging down and simply taking 80,000 off of each amount. So the first year I take 640,000 minus 80,000, leaving me with ending book value end of year 1 of 560,000. Minus 80,000 is 480, minus 80 is 40, minus 80, 320, and so on all the way down. Again, I can check my work 3 ways. All of these depreciation percentages should add up to 100%. All my depreciation dollars should add up to the original cost of the asset. And my ending book value should zigzag down to 0 if I've done my work correctly. Now I need to calculate after-tax cash flow. So first of all, I have to look at my ending book value end of year 5, $240,000. How much did I sell the equipment for? $175,000. So I've taken a loss of $65,000. For this, I get some tax savings from Uncle Sam at 35%. So 35% of 65,000 gives me savings of 22,750. So then my after-tax cash flow is simply the selling price of 175,000 plus my tax savings of 22,750 for an after-tax cash flow of 197,750. And there is your answer to problem number 7. In problem 10.8, we have a 5-year MACRS project. Acquisition cost of $6.1 million. We're going to sell this equipment for $1.3 million at the end of year 4. Tax rate is 35%. What is the after-tax salvage value? Equation: after-tax salvage value is selling price minus the tax on the gain. I forgot to write given up here. So again, I created an MACRS table. I go to the text and get the MACRS percentages for the 5-year, noting that it goes over 6 years. I list them right out of the book, right from the IRS, and I calculate my depreciation dollars by taking these percentages times the cost of 6.1 million. So 20% of 6.1 million is 1220000. 32% of 6.1 million is 1952000, and so on. All of these depreciation dollars should add up to $6.1 million if I've done my mathematics correctly. All my depreciation percentages should add up to 100%, or in this case 1. In this case I had decimals, should add up to 1. If I show them as percentages, they should add up to 100%. Ending book value is simply the beginning price of the equipment less the depreciation. So 6.1 million minus 1220000 is 4880000. Then I zigzag down, taking that minus the second year depreciation of 1952000 gives me 2928000 ending book value end of year 2, and zigzagging down, minus 1171200 equals 1756800, and so on down the line. By the time I'm done, I should zigzag down to an ending book value of 0 if I've done my mathematics correctly. In this problem, we're going to sell the equipment at the end of year 4. So where the book value remaining is 1054080, still on the books. We're going to sell this equipment for $1.3 million at the end of year 4. It says right here in the givens. So I have a gain when I take the selling price minus the remaining book value on the books. I have a gain of $245,920. When we have a gain in life, Uncle Sam would like some taxes on that. So our taxes are at 35%. 35% of 245,920 is 86,072 are my taxes. So my after-tax salvage value, which is what I'm looking for, is the selling price minus the tax on the gain. So 1.3 million minus 86,072 leaves me with an after-tax cash flow of 1213928. There's your answer to problem number 8. In problem 10.9, Kuiper Incorporated is considering a 3-year expansion project with an initial fixed asset investment of $2.7 million. They're going to depreciate this project straight line to 0 over the 3 years. And this project will then generate $2,080,000 in sales, $2.08 million in sales, cost of $775,000, tax rate is 35%. What is the OCF? When we see the letters OCF, we want to build an income statement. And then finally, OCF equals EBIT plus D minus T in the traditional approach. We will do a bottom-up approach to check that. So my solution, my vertical income statement, sales of $2.08 million, cost of $775,000, depreciation of $900,000 leaves me with an EBIT of $405,000. There's no interest expense, so I'll take my taxes out of there at 35%, and I get $141,750, leaving me with net income of $263,250. $263,250 is my net income. Now I can calculate my OCF by taking my EBIT of $405,000 plus depreciation of $900,000 minus my taxes of $141,750. I come up with an OCF of $1163250. $1163250 is the answer for my annual OCF, and that will come in for 3 years. It's a 3-year project, and so I will see the benefit of this OCF for 3 years. 1163250, 1163250, 1163250. Checking the OCF using the bottom-up approach, I can take, just to make sure this 1163250 is correct, I can take NPAT plus D because there is no interest expense in my income statement. So as a check, 263,250 plus 900,000 of depreciation, I get the same OCF, 1163250. And again, in some of the subsequent problems, we're going to have this coming in for 3 years. That's the answer to problem 10.9. For problem 10.10, we go back to problem number 9. And remember those cash flows we got for 3 years, 1163250. If the required return is 12%, what's the NPV on this project? So NPV is equal to minus the cash outflow initially, plus discounted cash inflows from the 3 out years. So my first initial investment is $2.7 million for the overall project, and for that I'll get 1163250, 1163250, 1163250 for the next 3 years on a non-discounted basis, but I must discount these cash flows first before I add them in. So I divide the first one by 1.12. 1163250 divided by 1.12 gives me 103,864,607. 103,861,607. Now I take the second one, 1163250, and divide that by 1.12 squared, and I get 927,335.78. And then I take the third cash inflow of 1163250, divide by 1.12 cubed, and I get 827,978.37. Now to get the net present value, I take the initial cash outflow, $2.7 million, plus the discounted cash inflows. So I take the negative 270,000, add back the 103,861,607, plus 927,335.78, plus 827,978.37, and I get a NPV of 93,930 and 23 cents. 93,930 and 23 cents is your answer to problem number 10. For problem 10.11, if in number 10 working capital is $300,000, salvage value of the fixed asset is $210,000 before tax at the end of the project, what are the new cash flows for each year? And again, on this one, we're interested in after-tax salvage value of that asset. So I have to take that into account when I'm calculating the new cash flows. And what is the NPV at 12%? NPV is minus cash outflow plus the discounted cash inflows. So a very simple formula. First of all, I have to calculate what these discounted cash inflows are. So my OCF, again, from all the way back to problem number 9, I have 1163250, 1163250, 1163250 coming in each year for 3 years undiscounted. That comes from the income statement. My net capital spending is $2.7 million for the initial cost of the equipment And then in year 3, I'm going to sell that equipment for $210,000. Now, I don't plug $210,000 into this box right here for net capital spending in year number 3. I take $210,000 minus taxes of 35% to get $136,500. Or simply, I could take $210,000 and after tax affect that and take it times 0.65 to get $136,500. So I plug in the after-tax salvage value in here, $136,500, not $210,000. For my change in net working capital, to get this project started now, it costs $300,000 of things like receivables and inventory, payables. And then when I close the project down, I turn off all the lights, I collect all my receivables, I sell all my inventory, and I hopefully get $300,000 back in. So there are my cash flows. Just add them all up, and those are undiscounted. Year times 0, today I have to put out $3 million. For that I get 1163250, 1163250, and 1599750 on a undiscounted basis. Now I have to discount all those at 12%. Obviously the $3 million is not discounted. The 1163250, the first one I divide by 1.12 to get 103861607. The second 1163250 I divide by 1.12 squared to get 927,335.78. And the last year's cash inflows total 1599750. I divide them by 1.12 to the third power and I get 1138670.45. I take those discounted cash flows and add them all together to get my MPV, and my MPV in this case is 104, 622.30, 104, 622.30 for problem number 11. In number 12, we're going to go back to number 11, and in this case, though, the asset now falls into the 3-year MACRS class. What are the new cash flows in this case, and what's the new NPV? So in the prior problems, all the way back to number 9, we had straight line depreciation. Now we're going to throw this asset into the 3-year MACRS class. So again, we're going to depreciate it over 4 years using the MACRS percentages and tables. And that's going to require us to build 4 years of income statements to solve this one. I'm going to let you try this one yourself. It's a little more challenging. So the MPV equation stays the same, minus the cash outflow plus discounted cash inflows. This table stays the same as in problem number 11, but we're going to get some new numbers because you need, in this case, you need to build 4 years of income statements. Sales minus cost minus depreciation equals EBIT minus tax equals MPAT. Then calculate 4 new OCFs. So instead of it being 1163250, 1163250, and so on, you're going to get new net incomes and new OCFs for each of those 4 years. Then you're going to plug those new OCFs for the 3 years. That's all you need in this case. In here where it says new, you're going to plug the new OCFs in there based on the new income statements, which are based on the MACRS depreciation. Your $2.7 million project cost still remains the same, but now your after-tax salvage value is going to be different because we're going to sell this equipment for $210,000 at the end of the project, but after tax, it's going to be worth $206,524.50 using the new depreciation. I'm going to let you see how to figure out that. I'll give you that little hint there on the after-tax salvage value. And then my $300,000 working capital and my $300,000 working capital stays the same at time 0 and time 3. So again, you're going to get an MPV by taking the discounted cash flows, inflows, the new ones, and add them to the $3 million out in time 0. I'm going to let you solve that one yourself. There's problem number 12.